All right, welcome in. Today, we're diving into a super practical, step-by-step explainer designed to help you build a bulletproof financial foundation starting literally right now. If you've got some hard-earned savings just sitting around and you're feeling totally paralyzed by all the choices out there, trust me, you are exactly in the right place.
So let's just tackle the massive elephant in the room. How should I actually invest my money? It's overwhelming, isn't it? Having savings just parked in a bank account almost always leads to this intense analysis paralysis. We're terrified of making a huge mistake, right? We don't want to pick the wrong thing or watch our money vanish the second the market takes a dip. It's completely normal to feel that anxiety.
But take a breath, because investing is not about predicting the future or having some magic crystal ball. Today, we're just going to follow a really logical, finite, four-step checklist. We'll start with overcoming fear, then hit step 1, the emergency fund, step 2, the portfolio, step 3, the accumulation plan, and wrap it all up with step 4, rebalancing.
Okay, let's kick things off right away with overcoming fear.
Here's the honest truth. 90% of beginner mistakes, they have nothing to do with picking a slightly suboptimal index fund. They happen because people skip steps, they let their emotions take the wheel, or they just sit on their cash waiting for this perfect moment that, spoiler alert, literally never comes. Making the absolutely perfect choice isn't the goal here. Disciplined execution of a really simple process is what actually builds wealth.
So you need a strict mental map, and here it is. Emergency fund, the portfolio, accumulation plan, and rebalancing. Think of it exactly like building a house. You would never try to put a roof on before pouring the foundation, right? You absolutely cannot skip a step. Step 1 is the foundation, step 2 is the walls, step 3 is moving in, and step 4 is routine maintenance.
Which brings us to that exact foundation. Step 1, the emergency fund. There is a golden rule you need to hear. The first step of investing isn't actually investing. It's building the cushion. This cushion is your ultimate insurance policy. Because life is going to happen, right? The car breaks down, you get a surprise tax bill, maybe you lose a job. If you don't have that cash buffer, you're forced to sell your investments at a loss just to get by. Let's look at how this plays out in the real world. Take Gianluca. He's got a super stable salary job. For him, a safety cushion of 3 to 6 months of expenses makes perfect sense. But then you have Elisa. She's a freelancer. Her income bounces around all over the place, so her math has to adapt. She needs a much bigger safety net, more like 9 to 12 months of living expenses.
Now, this doesn't mean stuffing cash under a mattress to gather dust. You want it working for you, at least a little bit, to fight off inflation. If you put it in a flexible deposit account or a monetary ETF, yielding right around the European Central Bank rate, which for context in our source material hovered around 2.25%, your money stays totally accessible for emergencies, but it's actually doing something.
Foundation poured? Awesome. Let's move to step 2, the portfolio.
This is where we build the walls of our financial house, using highly efficient, low-cost ETFs. Let's keep it really simple. You've got 2 main ingredients. First, equities, basically shares in global companies. These drive long-term growth, but yeah, they come with higher risk. Second, you have bonds, essentially loans to governments or big companies. These give you that much-needed stability and lower volatility. Over time, these two just balance each other out perfectly.
But how do you actually split them? Well, financial researcher William Bernstein has this brilliant shortcut. You calculate 2 things. First, your risk tolerance. Figure out the max percentage drop you could stomach without losing sleep and multiply that by 2.5. Second, your time horizon. Take the number of years until you need the money and multiply that by 7. Your target equity percentage is simply whichever of those 2 numbers is lower. That's it.
Let's run Elisa's numbers. She can realistically handle a 30% drop without panicking. 30 times 2.5 is 75. But she doesn't need this money for 20 years. 20 times 7 is 140. We take the lower number, 75, round it out just a bit for a clean split, and boom. Elisa's ideal portfolio is 70% equities and 30% bonds. It fits her exact profile.
Oh, one quick pro tip before we move on. You can add an optional airbag to this by allocating maybe 5 to 15% of your portfolio into real assets like gold or commodities. It acts as a massive hedge against sudden inflation spikes. Remember 2022, when both stocks and bonds suffered at the same time? This little airbag can really soften the blow. It's totally optional, but highly useful.
All right, moving right along to step 3, the accumulation plan.
This is where logic goes head-to-head with emotion. Logically and statistically dropping a lump sum into the market all at once beats spreading it out about 2/3 of the time, just because markets generally trend up. But let's be real, if investing your entire life savings on a random Tuesday makes you physically ill with anxiety, you're going to panic sell on Wednesday. Spreading it out over 6 to 12 months buys you massive emotional peace of mind. A slightly imperfect plan you can actually stick to is way better than a perfect one you abandon.
And the absolute best way to stick to it? A capital accumulation plan, or a PAC. This is just an automatic, mechanical, monthly investment plan. You set it up, and every single month it buys in. It completely removes the emotional temptation to pause your investments just because the news headlines look a little scary. You let the machine do the heavy lifting.
In fact, I want you to start looking at market crashes as the Black Friday of finance. Seriously, because when you have an automatic plan running, a terrifying market crash just means world-class assets are suddenly on a massive discount sale. Your mechanical plan effortlessly steps in and buys premium assets at incredibly cheap prices, while everyone else is running for the exits.
And finally, putting the roof on our financial house, step 4, rebalancing.
See, over time, your portfolio is naturally going to drift. Because stocks generally grow faster than bonds, a carefully planned 60-40 portfolio from 2019 could easily warp into a 74-26 split by 2026. Without any intervention from you, your portfolio unintentionally becomes much, much riskier than you ever intended it to be.
So how do you fix this drift? You just use one of 2 simple triggers. First is the calendar method. You literally just log in once a year, say every 12 months, and reset everything back to your original target percentages. Or you can use the threshold method, where you only step in when an asset class wanders maybe 10 to 20% away from its target. Either way, it keeps your risk exactly where you designed it to be.
And here is the hidden, counterintuitive genius of rebalancing. It mechanically forces you to do what everyone says to do, but no one actually does. Sell your winners while they're high and buy your losers while they're low. It forces you to do the exact opposite of what your panicked emotional instincts want. It naturally keeps your risk strictly under control.
So, you might have noticed something missing from this explainer today. No flashy crypto secrets, no AI trading algorithms, no overnight riches. Just a highly structured mechanical process. And honestly, in the world of personal finance, boredom is the most correct feeling to experience. If you are perfectly bored with your investments, it means you aren't making emotional mistakes. It means your plan is working, you are succeeding. So, I'm going to leave you with this final, kind of provocative question. Are you ready to get bored all the way to financial freedom? Because building lasting wealth isn't about the thrill of the gamble. It's about the incredible peace of mind that comes from a simple, disciplined, and flawlessly executed plan. Get your emergency fund set, build your simple portfolio, automate your contributions, and just embrace the boredom. Thanks so much for joining me on this explainer, and happy building.